Hey guys and girls, it's Nathan here from the Be Invested headquarters, the home of unorthodox financing and thinking of property strategies, as well as the OG of property portfolio building. Just want to reach out with you guys today because getting a few questions in from an article that was released yesterday from Westpac. It came from the AFR actually, the Australian Financial Review. And it was a story about Westpac and investments and stuff like that. See a few of you joining in. I'm seeing someone push Bitcoin already, but no, we're going to be talking about the old banking system and the banking system which has made all of us property investors wealthy over the years from being able to use the funding coming from the banks and all that sort of stuff. Just to get into the article for those of you that don't know about the story that I'm referring to. So it's a story from yesterday from Westpac, from AFR, and it starts off by Westpac, the nation's second largest lender, is giving risky property investors less than a month to find another lender amid growing concerns about the impact of rising rates, falling values and oversupply. The bank is sending a single-page letter to investors warning it can no longer support a commercial relationship with you, adding it will work with the borrower to help them find a new lender. Goes on to say the brief letter informs borrowers Westpac is a responsible lender, claims it can no longer support the relationship and volunteers to help them find a letter, he said. Just going on to, I've just got in a plain text format here. Westpac denies the claims. We do not support the claims made regarding the Westpac customer communications. Based on limited information we've been provided, the statements made are incorrect. It comes as new APRA analysis reveals a sharp spike in higher risk loans by major banks in the 3 months to the end of June, despite prudential regulators increasing pressure on toughening serviceability. Just going through, it's a pretty long thing here. It says Westpac moves comes amid intense pressure on lenders from rising lending costs, tougher prudential controls, and the interim findings of the Royal Commission into Banking and Financial Services, which has already provided humiliating disclosures about shoddy practice across the sector. Banks are forensically examining all of their books. The Westpac letters are typically being sent to interest-only borrowers with multiple properties and high loan-to-value ratios, usually above 30%, usually above 80% or more, and the investors often have up to 6 properties. Just having a look through here. Some of the affected borrowers have been told they have until the 20th of October, less than a month, to find a new lender. Mortgage brokers and buyers agents and analysts claim the Westpac letters are sending a shiver through an already nervous property sector facing rising lending costs and lower values. So that's basically the long and the short of the story that came out from the AFR. And I just want to give my 2 cents on what I see from that. So I want to break it up into a few parts. The first part being obviously how to structure your finance. From that perspective, it's always important to have a good strategy in place. Also want to bring up the fact that I warned everyone about this. I warned everyone about it. I talked about a GFD. People were sort of laughing at me saying, look, Nathan, the market's perfectly fine. Nothing's going to happen to the banks, etc., etc. I talked about this over the course of the last 2 years. People thought I was crazy. People thought I was delusional. People thought that I'd lost the plot. Is it all bad? Am I concerned about it? I think it's very important to understand the environment that we're in at the moment. I think that we're on the eve of something that's going to be much greater than the GFC. We're looking at a liquidity crisis. This is very different to previous sort of recessions and stuff like that. The reason being is that this is not a recession. This is a credit and liquidity issue. It is the ramifications from what saved us from the GFC. This is not a housing issue, in my opinion. Housing is a byproduct of the financial markets. It's a global issue. If you look at the news coming out globally, I encourage everyone to look at global news and see the common trends. This is not a thing that's just Sydney or Australia or anything like that. If we look at the Banking Royal Commission, That's occurring globally. If we look at the Glass-Steagall Act, which is being implemented, that's happening globally. If we revert back to my 5-part video series that I did, the webinars that are on our YouTube channel, they're about an hour and a half each. I did talk about how the banks, how in Parliament on the 14th of February this year, 7 people were in Parliament and they enacted to remove the 250,000 deposit insurance scheme. And all these things are leading up to what I've been talking about. Do I see it as an issue moving forward? I think that we're going to start seeing some things which will be like this. Have we seen these in the past? Yes. Why did we see them in the past? What happened in 2007, 2008 was when we had a liquidity crisis, and there was an issue because of some shoddy practices in the US, which ultimately resulted in lots of money printing globally. Basically, what happened in that period of time is some of the banks ran out of liquidity. We saw merger and acquisitions of banks at that period of time, and there was a couple of banks which I'm not alleging this may be the case. I'm not accusing a bank of being like this. However, there was a couple of banks that were on the edge of being insolvent at the period of time. Those banks that were almost insolvent did do a thing called an all monies clause, and what this is an all monies clause. So in every finance contract, mortgage agreement or whatever, it always says that the bank or the lender can actually revoke the loan at any period of time in order to make monies due and payable within 28 days or whatever. And this is what's occurring here. The difference here is that a lot of people may not service, given the new lending criteria. They may have to go to the different type of banks or different type of lending, such as second and third tier lenders. So I think it's important for people not to get stressed. If you have received one of these letters, I haven't seen a letter. Fortunate enough for us here at Be Invested, our clients, 99.9% of our books are 20% deposits when they buy a property. So they're over the 80%, or they're under the 80% LVR. We don't use Westpac as a lender, so we're sort of protected from that front. But it doesn't mean that other banks won't start enacting some of these things. So it's just part of a normal market cycle. The banks are in a liquidity issue. They're getting pressure from APRA, from the Royal Commission, etc. But I think that when investing, it's important to be protected and have the right strategy moving forward. Now, the reason why I say that is, let's assume that you've got 10 properties and you are one of these high-risk investors that the bank's talking about. If all of your loans are with that specifically one bank, that does leave a cause of concern because the bank has more of a control. If you have, say 10 loans and they're with 3 different banks and you've got 3 loans with each bank, then your risk is much lower and it's a much lower risk appetite for that lender. So it may just be a simple task of reallocating your debt and being able to reposition yourself in your portfolio to ride through the storm. So I did encourage people going back 12 months ago, 18 months ago, 6 months ago, to take a look at their equity positions, pull out whatever equity that they had to protect themselves from that side and keep it at an offset. I did, recommend people to go and speak to a finance strategist in order to get their affairs in order when it comes to the lending practices that are out there. So yeah, with it, I still keep the same view on that. However, the doors are closing because the banks are getting much tougher and much stricter on their lending practices as it is. So you want to obviously be with the bigger banks because, obviously they're much cheaper to use and all that sort of stuff. However, these are some of the risks and issues that do come out there. So yeah, with it, I haven't seen a letter. If someone has got a letter, it would be interesting to see it. If you do have questions on from that side, please feel free to just drop us a private message, and I'll put you in contact with my finance team if you want help on sort of restructuring your portfolio to protect yourself through this. Is it something that I've seen before? Yes. It happened throughout the GFC. There were some larger banks. I was aware that NAB actually did this to a lot of people back in the GFC, and I got told, for whatever it's worth, all intents and purposes, that it was due to a liquidity issue. But generally, when a bank says something like that, if me reading into the article, it does show that it is a bit of a weakness in that lending institution to be calling these sort of shots. So, yeah, that's just my view on what has come out of that article. It's something that, I'm not going to go on. It's not something that I'd get too concerned about. I see a lot of people messaging in and asking the questions. If you haven't spoken to someone on a finance front for a while, I'd encourage you to do so. And make sure that you restructure, your finances. Make sure you don't take any risky positions by buying, with high leverage sort of portfolios. There's a lot of people out there over the course of the last few years that have, suddenly all become, property experts and all that sort of stuff, saying go get a credit card, use a 5% deposit, all that sort of stuff. I always say never ever put yourself into those sorts of positions. So. The banks may negotiate with you. You may be in a position where the banks can negotiate with you to maybe pay down some of your debt, lower that LVR position, maybe change it to principal and interest, so on and so forth. But it's still very early days. I haven't had any communication on that front personally, and I don't really trust what comes out of the mainstream media to go, yep, that's exactly what happened. But just my view on it, it is, in my opinion, what I feel from it and what I have felt from beforehand. I did say that last time when we saw the GFC, that we saw, some companies that caused some bad things, did some wrong things, go under, which was in the US. This time we're starting to see currencies and countries get themselves into trouble. Is it something to run for the hills? Is it something to sell your properties? No, it's not. Am I selling my properties? No. I sold a couple of properties going back about 12, 18 months ago because I was facing some APRA issues because I was settling a lot of property. I had like 20 properties I was settling, and they were large ticket items. And I sold some properties off at that point. However, my view is a long-term view. My personal investing strategy is a long-term strategy. I realize that this is a season that we're going through in, property land. And, the day that stimulus comes in and the market takes off again, it's important to have those properties in your portfolio because you want to see them double. If suddenly tomorrow or 12 months or 18 months or 24 months, 36 months, whenever it is, and we start seeing another sort of bull run in the property market, are you going to be able to, have enough properties under your belt in that quick period of time in order to see them go up and double and do their thing? And quite likely the answer is going to be no. With it this time in the marketplace, for me personally, I love these markets because there's people that are fearful, there's people that are making wrong decisions, there's people that are selling when they should be buying, etc., etc. And being able to pick up all those bargains is what I get excited about. I don't mean to laugh about that because some people will make sort of wrong decisions, but that's why we're here at Be Invested, to make sure that you make the right decisions by having the right knowledge and the right education in order to do so. Just on a final note. Just got a little note here. If you do need help on a finance front, the office number for Zinger Finance is 1300 882 022, or send us a private message, and my finance strategist can help you assess your position, look at your portfolio, and try and help minimize that risk if you are in a risky position. And it's always good to have an expert set of eyes overlook your position to either say that you're doing something good or something that you can improve on, and make sure that you maximize your returns and minimize your risk along the way. We'll catch up soon. Have an awesome day, and if you've got any other further questions, either messages or put it in the comments below. We'll catch up soon. Bye.